Good morning, welcome to The Mint. I'm Andy Hodges. In our main story this morning, we look at the Zimbabwe Stock Exchange and its remarkable movement or bull run since the beginning of 2020. The Zimbabwe Stock Exchange closed last week on a high, gaining 16.55% up with no counter losing ground over the period. This week, the bourse further gained 4.01% on Monday, before retreating on Tuesday this week by 1.74%. But here is the interesting fact. At the end of 2019, the Zimbabwe Stock Exchange had a market capitalization of 27.7 billion Zimbabwe dollars, or around 1.2 billion US dollars. At that time, market analysts forecast that the market was undervalued, and yes, they appeared to be correct. As at the 18th of February 2020, the market capitalization stood at 68 billion Zimbabwe dollars, or 2.26 billion US dollars. So in just over a month, the market capitalization in US dollar terms had gone up over 1.1 billion US dollars. Market watchers still believe that even at these current levels, the market may still be undervalued in US dollar terms. Top gainers year to date are OK Zimbabwe rising 346%, Kafka up 279%, Meikles up 230%, Ariston to 80%, and Axia 196%. In fact, all counters on the bourse had some level of gain over the period. The question, of course, is why is this bull run happening? Well, analysts have attributed to a variety of factors ranging from money supply growth and investors using the ZSE to hedge against inflation. The Mint spoke to Ray Chipendo, Head of Research and Emerging Securities based in Johannesburg, South Africa. We asked him what were the main drivers of the bull run.
Going into Q4 2019, the markets were becoming quite jittery and anxious about the economy and about the performance of companies, primarily because of companies such as Delta, which report quarterly updates which were quite negative, where we saw volumes contracting by more than 20%. And with the general news of electricity and all of those things, the market were justifiably very anxious about financial results. However, getting to December 2019 and for the most part January 2020, the results that were released by a number of companies tended to come back much stronger than we feared. So I'm talking about Delta itself. So despite volumes erosion, earnings and revenue came out quite strong. So I'm talking about, as I say, Delta, OK, Zimplo, all of these companies were coming up with earnings growing at triple digit. An explanation to that is I think companies were increasing prices faster than inflation, and so those types of increase made up for the volumes contraction and gave result. So what you saw is earnings relative to price, which is your PE ratio, really significantly went down to single digits, which rendered most of the stock prices cheap. Second part has nothing to do with fundamentals. I think it's technical. So you may have heard the announcements by the Reserve Bank governor that half of our bank balances are controlled or owned by about 200 odd institutions. So, and then the Reserve Bank governor conjures up a plan to say, hey, in terms of redistributing liquidity, why don't we turn part of your bank balances into corporate bonds? So put yourself in the shoes of one of these institutions and you are told that, hey, in a month or two, we will quote unquote garnish your account and force you to take corporate bonds. If I were one of those institutions, the most reasonable thing to do before the debt is to probably move some of the money into an asset that can shield me from some type of inflation. I don't know if we are going to experience what we experienced last week again this week or next week. I think that the markets have taken a breather. I think that people are beginning to take off their money, those that made huge profits. And I think we may be entering into reversion to normal where moderate stock market gains are experienced. But that will pretty much depend on two factors, which is A, the fundamentals. So mind you, more than 50% of the companies listed have a financial year end of December. So end of February to March will be a hive of activity as companies report their earnings and financials. If the financials come out strong and confirm what we've seen, which is earnings, companies are performing better than we feared, then I think we will continue to see the ZSE index in total going up. But if we begin to perceive weakness in terms of the results, then the markets will start to price such weakness in form of price drops. The second point has to do with the role of the market, which is to sniff out recessions, inflation. So markets are known best to be able to price in inflation, expected inflation. And that will pretty much depend on what the Reserve Bank does and does not do. So if the central bank sticks to its word of bringing down inflation, I think that will be reflected in the markets. And if the government does its best in terms of building the economy, trying to resuscitate the economy, and if there are results to confirm that, then that will also be reflected in earnings and in the stock prices.
We further asked Ray how long he thought the bull run would last and if he thought the market was still undervalued.
So in the first 2 weeks of the year, 70% of all the listed companies were rated either as a buy or as a strong buy, and 30% were hold or sell. So now pretty much the opposite has taken hold. 30% of the companies now are either strong buy or buy, and 70% hold or sell. And that is as a result of the price appreciation we have seen. And one other important insight that we have noted in this last rally is that companies tended to go up under a sector theme. So you may have noticed that FMCGs had a good rally, retail companies had a good rally, and I think that it was just not individual company merit, but the whole cloud of the sector.
As we have said here on The Mint many times before, we recommended that investors should look at the Zimbabwe Stock Exchange as a way to maintain value of your hard-earned money, and we were not wrong.